She is one of our newest. She's one of our newest affiliates. She also joined the Columbia River as a full member. So she's supporting us on a local level, also nationally. And a lot of people may or may not know of Incite Strategies, but that was Ivory's passion to bring solutions to the consumer that are having experiences with the bad players in credit repair world and getting taken advantage of. So she is a godsend for people in this realm of trying to maneuver through being credit worthy. And she's very passionate about it. She has created basically a kind of a education schooling on being credit worthy for the consumer for free. And also just bringing to us as members firsthand knowledge coming off of a conference. So yeah, just always know Ivory is available to answer a quick question or whatever, but her team is dynamic and I'm just thrilled to have her be part of this. So welcome, Ivory Becker.
Thank you. I appreciate it. Okay, I'm going to start by sharing my screen because I feel like the technology is always the hardest part.
Yes, love it when it works.
Make sure we get it all going. Okay. So today I'm going to be talking about the credit score models that are changing. I enjoy these types of discussions to be interactive, so please don't hesitate to ask questions. I might not have all of the answers. There are some things we just don't have answers for yet, but everything I do have answers for, I'm going to share with you. And then I'm sure as time goes by, we're going to be doing follow-ups on this as more information rolls out. And then I guess feel free to ask in the chat, or if you're not shy, you can definitely, of course, just unmute yourself. But I hope this is very, very helpful for everyone here today and anyone watching the recording later. So thank you for the wonderful introduction, Annette. My name is Ivory. I own a couple of different organizations. One's called Incite Strategies Credit Solutions. I have a credit education course called Credit Worthy, and then co-founder of an AI credit software called Credit Score Pro. So everything credit related is really my passion. We help consumers, and then we work with nonprofits. We work with, of course, mortgage loan officers and everyone in between that touches credit, which is every single one of us. So our goal is really just to make sure we keep everyone educated, whether it's on the professional side of things or on the consumer side of things. So today is all focused on, oh, enter isn't working. There we go. Today is all focused on the changing climate and credit when it comes to mortgage lending. There is a big rollout. I feel like initially when it was discussed, it kind of hit the headlines for a moment and it's flown under the radar for a while. We're going to start by looking at what kind of credit models we're using in mortgage lending now. I just want to make sure we're all on the same page. We all have the same foundation, and then we're going to transition into what these big changes are, and then what that rollout looks like and how it's going to apply to you and then your clients. So let's start by looking at mortgage originations. The most recent data, I finally got it. I've been running with data from 2020 for way too long. I finally got 2023 data. No 2024, but an estimated amount right now, about 30 to 35% of inquiries actually become applications for mortgages. So you are doing a ton of work for only a small amount of people to actually apply for a mortgage. And then out of 10 million mortgage applications in 2023, only 5.7 million people actually got mortgages. This was down, of course, from prior years. And that 43% fallout rate is really what we're going to be focusing on. And this is part of what's driving these score algorithm changes as far as creating more qualified borrowers so we can have more homeowners. So this data is reflecting the entire US market. And if we look at that denial rate, that 43% that's fallen out of that application process, we have 10% incomplete application, right? So some of them just didn't follow through. But 55% of the denials were from debt to income ratio and credit history. So more than half. So a big, big, big impact is obviously the credit and DTI, which is why we're here today. So let's start by understanding the score algorithms and where they are at right now. So we currently are using what's known as classic FICO. So if you are not aware, the algorithm used in mortgage lending is different than any other type of lending in the US. Pretty much the only industry still using this model is the mortgage industry. I haven't heard of any small banks or credit unions still using it. So it's from 1989. It's looking at these 5 primary factors. So we've got the payment history, amounts owed or utilization, length of credit history, new credit, and credit mix. It's all based on a snapshot in time. So whatever data exists when you pull the report today, populates and creates the report as of today. Keep that in the back of your mind. That's going to matter a lot more later in today's discussion. And then, of course, we can use tools now like Rapid Rescore or Wayfinder to create immediate score boost potential, or relatively immediate score boosts. Now, if we focus down on what this pie chart actually means, if we're looking at payment history, I'm just going to dive into this a little bit because if we don't all have the same foundation, you're not going to understand the differences and what's changing with the interpretation of the data, which will affect how you advise your clients. So let's review. For some, a review, and something should be probably new to you as well. So when we look at payment history, that's 35% of the credit score. Actually, I'm going to take a step back. Does anybody know what happens before we even get to the point where we're looking at these data sets for consumers to create a credit score? Probably not. I'm just going to dive into it. So before you're even put into this model or this algorithm, consumers are separated into what's known as scorecards. So it's demographic buckets. So the whole point of a credit score is to assess risk, right? So what they do is they take similar profiles. For example, someone who has very limited credit history is one type of demographic, where someone with very long credit history and no negative payment history is another demographic. They're not comparing those two people together because they're not similar. They're not similar sets of people. So they take all of these different demographics, and depending on the score model, there's anywhere from 7 to 10 different scorecards. And then they're comparing the people in each like group to each other. So you're rank ordered against peers in that like group. Why does that matter? Because if your demographic changes, if something about your profile changes, it could cause you to jump into another bucket and be compared to a new group of people. This is why different behaviors, you'll hear people like, well, my neighbor next door got a new credit card. It jumped his score 10 points, but for me, it only jumped mine 5. Well, because you may not be in the same demographic, right? It's not necessarily that simple. Make sense to everyone? Did I lose anyone? No? Okay. So once we have that demographic determined, and we're starting off with that level playing field of people in a similar or like group as us, then we start breaking down and looking at these factors. So number 1's payment history. This is looking at, I think, the obvious. Do you pay on time or not? Now, what most people don't realize is once your accounts are closed, that payment history is no longer factored into your credit score, even though you see it on the credit report. The exception to that rule is going to be negative information. If you have a missed payment, that is still factored into your credit score. So that being said, you may look at someone's credit report and they have 20 closed accounts, only 2 open accounts. Those 2 open accounts are the only things driving their score, if those closed accounts are all positive. I think that's something most people don't realize.
Not at all.
Yeah. And then the next category is amounts owed. This is just utilization. So utilization is looked at in a couple of different ways. First, let's level set. It's only looking primarily at revolving debt. So credit cards, lines of credit. And there's 2 different assessments. One assessment is each individual credit card. So your balance versus your credit limit for each individual card. And then there's another assessment based on all balances versus the total of all balances versus the total of all credit limits. So there's 2 different calculations that are happening there to impact that category. Now, the only time this category you'll see a loan affecting somebody is if somebody owes more than the original loan amount. So does anyone know when you would ever owe more than the original loan amount?
Student loans.
Student loans, exactly. And I will say, the more data you have on the credit report, the less impactful that balance versus that owing more than the original balance is going to impact you, because it's still less impactful than things like credit cards, but it does factor. So that's really the only time we see it as student loans. The next thing is the length of credit history. Now, again, where this trips everybody up is it's the length of open and active accounts, right? And this is where credit cards can be really helpful. Obviously, we're not keeping car loans forever or personal loans forever. So this is really focusing on what is the average age of the open accounts on my credit report. So you can influence this pretty easily through having credit cards. And this is also why you'll see the big score drops when people pay off their car loans right before they apply for a mortgage, especially if that's creating a lot of length in their credit history. Okay. The last couple, credit mix, very self-explanatory. Do you have a blend of different types of accounts that you pay responsibly? Again, this is meant to assess risk. So that's really what the algorithm's looking for. And then lastly is new credit and inquiries. This category is really just your red flag. So if you've newly opened an account, it's a red flag to lenders. Make sure that you're not overextending to them. Make sure you're not letting them borrow too much. So there's a little score drop temporarily until we see payments show up on the credit profile. And then inquiries, same type of thing. There may be a new debt that hasn't appeared on the credit report. So red flag. Let's just be aware of that. That's really it. It doesn't impact scores much. Any questions on any of that at all? Okay, we're good. So that's our foundation. We're going to build everything off of this foundation for the rest of today. So, did you know that there are different models within the FICO algorithm? So think of this like iPhone generations, right? You have your very first iPhone. It did what it was supposed to do. It didn't have a lot of bells and whistles, but as time goes by, there's more bells and whistles. The cameras are better. There's more memory, right? All of those things change, and it's the same with these different FICO models. So when I talk algorithm, the algorithm is FICO. The models are the different versions under FICO. Hopefully everyone is catching on with that, because we're going to be talking about algorithms and models a lot today. So we started off with the version used in mortgage lending. That's the first standardized FICO model. And that's, you'll see here, let me use my pointer, my laser pointer. That's right here on the screen. So 2, 5, and 4. The bureaus were allowed to use a different.
I'm headed out here. Is Andrew here?
So the bureaus were able to use their own numbers previously, and then they said, hey, that's too confusing for consumers, so we all have to use the same number. So 2, 5, and 4, it's all the same. It's all the same model of credit score. And then over time, they added new models. So you'll see the more recent ones that are still used are 8 and 9. Primarily 8 is the most widely used model. And then there's industry specific versions where they have, I won't go into that today, but there are industry specific versions. We'll save that for another day. But what's important to know is your clients are, if they're going to experience website, they're seeing this right here. If you're using the Bureau's website to get their credit scores, they're seeing FICO 8. That's why it's never going to match what you have unless they're doing a paid version of Experience app where it gives them all these different credit scores. Okay. So we also have the credit score algorithm called Vantage Score. You all are familiar with Vantage Score, whether you realize it or not. That is what Credit Karma is using. Or CreditWise. We have a lot of clients, of course, that say they use CreditWise in their Chase app. Vantage scores are offered for free, where FICO scores, institutions have to pay for them. So they're becoming more and more and more popular. So until recently, the FICO scores were used in 96% of lending decisions. Last year, 42 billion Vantage credit scores were used. That's a 55% yearly increase. And you can see, I put the beautiful chart showing. So we're starting to see the biggest banks, all the fintechs really starting to use the Vantage score. A lot of that is also because they provide access to tons of data to the public. Where FICO they're tight-lipped on everything. They don't give a lot of data. Now, if we're looking at Vantage score and we're looking at FICO score, what I want you to know is the comparisons for payment history. Payment history is 41% of Vantage, 35% of the FICO score, right? It's not an apples to apples comparison. And this is another reason why you're never going to see the scores match when somebody pulls their Credit Karma score versus when you pull their credit score and you get the FICO score. And just like FICO score having these different versions, these different models, Vantage score has the same thing. They have, oh, one more slide. They're on to 4.0. So 4.0 is the newest, right? They keep it a little bit easier. They go in numeric order rather than skipping numbers and going everywhere like FICO does. But the algorithms are similar data, looking at it in different weightings, but also the interpretation of the data is different as well. But they both have the same goal of assessing risk. So 45 million adults lack a FICO credit score. And this is because the FICO scoring criteria requires at least one credit account to be open for 6 months. And you must have one account reported to the credit bureau within the past 6 months. So basically you have to have activity over a 6-month time frame. If you have old closed accounts, so you can have someone that has 20 closed accounts that have had no activity in over 6 months, they have no credit score. So it's more easy to become unscorable with FICO. Why am I bringing this up? Because of those 45 million unscorable FICO score people, however I want to put that, 33 to 40 million adults have a Vantage score that do not have a FICO score. Because to qualify someone for a Vantage score, it's much easier. So if you've ever had that client that comes to you that says, well, I don't understand why you're saying I don't have a credit score. Credit Karma told me I do. Well, that's because it's easier to get a score on Credit Karma. So why am I talking about Vantage score and FICO score? If in mortgage lending right now, we only use a FICO credit score. It's because it's changing. So this old model from 1989, this classic FICO model, is going to no longer be used in mortgage lending. And we are now being introduced with the usage of 2 models or 2 algorithms with 2 new models. That's going to be the FICO score 10T, which was created in 2020, and the Vantage score 4.0, which was created in 2017. I don't know where the rest of my sentence went. But the 2017 Vantage score, it was the first credit score model to use trended data. We're going to talk about what that is. It was the first one to use machine learning, and there's some other differences that we'll look at as well. So the whole reason for this change is better accuracy, better risk management, and increased access to credit, right? We talked about how few people are scoreable on FICO. We're trying to make it so more people can qualify to borrow. Oh, well, there we go. More people qualified to borrow. So based on looking at historical data for denials, about 10 million consumers would qualify based on making no changes to their credit profile if we would have been able to use a Vantage score versus no FICO score. Or base, you know what I meant, instead of having to use a FICO score. So here's what's going to change. Lenders are going to pull and deliver both a FICO 10T score and a Vantage score 4.0. So you're going to be pulling 2 algorithms, 2 sets of credit scores. So each score will be provided to each borrower. And what's really interesting is they're talking about going to buy merge reporting. So this is a big reason for the delay in the rollout right now. There's been some concerns about risk with only having to use 2 credit bureaus versus having to use all 3 credit bureaus. And obviously it poses a risk of being able to cherry pick, right? If a consumer knows, oh, well, my credit score and experience way lower than Equifax and TransUnion, just pull those 2. You're obviously going to pull the higher 2 bureaus, right? So a big cause of the delay of the rollout, because the initial rollout for this change of going to 10T and 4.0 was supposed to happen by December 2024. So obviously we're well past December 2024. They're also looking at changing the methodology for looking at the score weighting. So 2 options are considered average then lowest or average then average. So still no final decision has been made on that. It looked like final decisions were made, and then investors were like, whoa, 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 hold up. We don't like the way you're talking about rolling things out. And that's the big reason for the pause. Any questions on any of that at all? No? Okay. All right, we will move on. So what's important to know about both the Vantage and the FICO scoring? They both go 300 to 850. I don't think you're ever really seeing scores at the 300 range. Lowest we usually see is in the 4s. Both scores are going to implement using historical data. Both scores are going to be delivered at the same time when you pull credit, right? So now we want to compare the details and the differences of the FICO model and this Vantage model. So what I mean by that is we're going to start by looking at FICO 10T. How is it different than classic FICO that you're used to? And how does that adjust how you're going to want to advise consumers? And then we're going to do the same with the Vantage score, the new Vantage score. So FICO 10T has a significantly higher predicted accuracy risk for default. It's about 10% more accurate. Investors like that. That's actually a very high amount when you're talking about being able to predictively measure default. It is much stricter on certain negative behavior, so much stricter on delinquency of certain types. And then Vantage Score has already released all their historical data sets where FICO hasn't. That's another cause of delay currently. But if you are at a major lender, you also can get the kind of behind the scenes information on FICO 10T that's not available to the public. So I don't know if anyone here watching or attending is at a major lender, but you may have some access to the behind the scenes FICO 10T data, and you'll have a little bit of a competitive advantage over everyone else. So here's some key changes to the FICO model. Delinquencies can be more damaging to the credit score than prior versions. So it means bigger drops in the score for late payments and bigger drops, especially for a recent late mark, because a recent late mark means current hardship. Currently, we see drops for recent late marks upwards of 100 points. So that means it could be even greater. So that's very scary for that's very scary for those who just, thought they had something on auto pay or their bank account changed and they missed that one mortgage payment. Now all of a sudden, that person going from 800 to 700 might be going from 800 to 650 or lower. So it's also looking at debt differently. So with this new model, they're essentially looking at the risk level of debt. So obtaining a personal loan is more risky than obtaining a car loan. That's now going to be factored into the model. So if you are a consumer and you're taking out payday loans, payday loans, personal loans, debt consolidation loans, those types of debts are going to rank you lower as compared to peers who may not have those types of debt. And now there are some good things too. So one of the good things is you can add the rental payment history to the credit report and it will be factored into the score. So for those of you who've seen clients using things like Experian Boost, or having their rental history added to their report on your classic FICO model, that's not actually adjusting the score. It's doing nothing for that credit score. So with this new model, they will be able to proactively add credit building tools, add their own bills and payment history to their report and see a score improvement. And that's something that will positively affect their credit profile, meaning you may be able to qualify more people or help people get higher credit scores more easily. This new model is also going to ignore all paid collections. So if you're not aware, on your current model with classic FICO, whether a collection is paid or not, it affects the score the exact same way. So there's no positive impact with the current model for paying a collection. With this new model, you will see a score boost. So there is a reward now for paying a collection. Now, nothing's really going to change with medical collections with the new legislation that's passed. All medical collections under 500 still won't report. All paid medical collections will still come off the credit report. So there really isn't any change there. And then credit card debt is going to have a bigger impact with FICO 10T. That's probably my biggest concern when I look at this. And there's some pros to it as well, but we know right now we're in a credit card debt crisis. So if you have individuals coming to you that are telling you right now they're not ready to buy for a year, these are going to be the people you really want to discuss how they're using and managing credit cards, because there are actions they can take now that will affect their scores later when you start utilizing these credit scores. So utilization is going to play a bigger role. We're going to look at that in the next couple of slides. And this is really where we're going to dive deep, because this is where the machine learning component comes into play. So we're introducing what's called trended data. Now, this trended data is going to be on both Vantage and FICO, so both 10T and Vantage 4.0. Okay, and this is probably the most important thing you can take from today. So now, instead of, we've talked about how credit right now is a snapshot in time, right? We can have a borrower get a gift of $10,000. They get their credit card debt paid off. And then we do a rapid rescore. Boom, their score's up. That's no longer going to be the case. Not with the introduction of trended data. It's looking at how the consumer has managed their credit over the past 24 months. So it's the obvious word, it's taking the trend. And now it's pulling data at set times each month, and depending on the type of data, some pieces are pulled more frequently than others. We'll look at that a little bit later. But it's going to start factoring in people who are transactors versus revolvers. So let's talk about what a transactor versus a revolver is. So a transactor is somebody whose balance doesn't really change. Their balance stays the same. They make their minimum payment, and their credit card balance just stays the same. Okay. We've got the revolver who over time their balance is less. And what's really interesting is people who max out their cards but pay the full balance off every single month are no longer going to have the issues that they have been having, to where if you pull credit on the wrong day, their score drops. It's more volatile. It has these big up and down swings. That's going to be going away to now it's looking at that overall trend. The data is going to show now that because they pay off their full balance every single month, they're ranked higher. Their score will be higher in the new model than it would be today. And what also is great is that consumer who doesn't have a lot of extra funds, but is slowly paying down their credit cards, is going to be rewarded. They will have a higher credit score in this new model. So right now, these three consumers that are being compared, someone who pays down, the steady user, and the balance builder, the person increasing their balance over time, all in today's model are at a 675. In 10T later, that person paying down over time is a 750. What a shift. Because these individuals are now being rewarded for reducing their risk. They're showing behavior that is positive, right? The steady user, they're pretty much the same for the most part. And then the person that is increasing their balance slowly over time, they are deemed higher risk. So this is more accurately meant to assess risk, and more accurately predicting the likelihood of default. Any questions on any of this at all? Okay. All right, well, I will just keep on moving on. So VantageScore 4.0, this is changing as well. I wanted to show you this portion and bring this up because I don't know if Credit Karma is going to shift to the 4.0. Excuse me. Credit Karma right now is on 3.0. So I wanted to bring this up because when we do make this transition to using 4.0, even their Credit Karma still may not match. So how frustrating is that? Hopefully Credit Karma just starts using 4.0, but right now they're still on 3.0. So there just may be my only point in this is, hey, wouldn't it be nice if we could just have something that matches what the consumers are looking at? I don't think we're going to get that lucky anytime soon. But there's a slight adjustment to looking at the overall weightings of everything. So what you need to know about 4.0, paid collections, medical debts are entirely ignored by the model. So medical debts, paid or not, well, paid fall off anyway, but unpaid medical debts not factored in scores at all. So that's now going to align with your discussions with consumers about underwriting not necessarily caring about the medical debt. Now it's also not going to affect scores, which is great. First mortgages are going to be handled differently than other types of mortgages. So they're going to assess risk differently from the primary mortgage versus like a second lien, a home equity loan or line. So that's interesting. We don't have the exact information yet on how they're looking at it different. This Vantage 4.0 has already rolled out. They just haven't given us that data. I'm not sure why. I'm sure we will get it. It may be something where they're still adjusting the model on how they want to interpret that information. Rental data, same as that, the FICO 10T, it's factored into the credit score. So now you can use self-reporting to create quick score boosts for consumers. Collection accounts, same as the Vantage 10T, FICO 10T. So. Okay, let's see. The scorecards. So I mentioned the different demographic buckets that people are put in. Vantage makes it extremely simple. FICO's much more complex. So Advantage, they just put people into these buckets. Not scoreable, dormant, not scoreable, they have no credit at all. Just nothing. Dormant, they haven't used credit. Thin or young credit profile, exactly as it sounds, not much credit history. A thick profile, a lot of credit history. So anyone with a lot of credit history compared together. And then they have a category where they break people down based on risk. And then there's subcategories to that. So I don't really need to get into the details of that. If anyone really likes the data, we can have long conversations about scorecards and how those work. But today I won't dive into that. So the trended data. So earlier I mentioned how Vantage Score gives us more information on the algorithm than FICO does. This is what I mean. They actually spell it out pretty plainly for us and how that trended data model works. They're looking at certain data over the last 3 months, 6 months, 12 months, and 24 months, and then they're making comparisons. What do the behaviors look like? How are the behaviors of that consumer changing over those timeframes? And that allows them to determine how much risk that consumer is. So when we're talking about credit scores in general, they've always meant to be a predictive model, right? How much risk will this person be in the future if I let them borrow, right? Because the whole point is that model, score, is for the lender. It's not for us as consumers. So by this introduction of the trended data, they think they're going to be able to reduce default pretty significantly overall for all types of debt. But the trended data looking at credit cards is really going to be the game changer. So it's looking at all of these different pieces of the behavior of credit cards, not just utilization. So all we've had up until this point is what is the utilization? What is the balance today versus the credit limit? That's it. So this is a massive, massive change. Anyone have any questions on any of these points? I'll leave it up on the screen for a moment. But I didn't want to dive into, I can get pretty in the weeds. So I wanted to keep things fairly high level today. So there's a lot of behaviors that never factored in before that are going to factor in now. So people who like to make multiple payments a month or are really showing they're trying to pay down balances are going to be rewarded, where before it was like, well, that does nothing for you. So this is an interesting one I'll bring up. Time since most recent over limit. That's never been factored in before. So someone who was recently over limit and is repeatedly over limit is now going to be seen as higher risk rather than just that snapshot on that single day where they were over limit. So, all right, we'll move on.
I have a question.
Yeah.
Since the trend is going to be every 3, 6, and so on months, does that mean we're going to need to see it reflect every month still, or do we have to wait 3 months?
Yeah, no, you'll see it reflect every single month. It's basically the assessment, the reassessments happening every 3 months, and then a comparison of 6 months to the prior 3 months, a comparison of 12 months to the prior. It just keeps going. And what will be interesting, there are some loan officers now that are already getting the lender reports, and they're seeing the trended data on here. So you'll be able to see, they basically added new data fields to the lender report that show all of this information and give you not all of these details, but some of these details. So you can even see why the consumer was ranked higher risk, why their score is a bit lower. It's very interesting. So once this fully rolls out to every single lender, you'll be able to tell the consumer this is exactly what's going on.
Got it. Thank you.
Yeah. So the benefits of the new models, really it's meant to be broader range of consumers that can qualify, better risk assessment, and more data. So I want to talk about what this means for credit improvement options, because obviously if you get those borrowers that are just on the cusp of qualifying, or maybe they want a better interest rate, more loan options. There's going to be less options available for short-term quick boosts when it comes to things like rapid rescore. Obviously, if it's looking at the trend of behavior, you can't just be gifted a big lump sum of money and then all of a sudden see a giant score boost. Let's see what else. So rapid rescore I mentioned. And obviously, I think this is the big one. Consumers are now going to be rewarded when they're trying to pay their debt off, even if it is slowly. I think that's one of the biggest frustrations I hear quite a bit for consumers is I have been doing my best to pay down my debt over time, and my score is just not changing, and they get really frustrated. I'm hoping this will encourage people to continue paying down debt because they'll actually start to see the positive impact in their scores, whereas right now they don't see the impact. So I guess just to kind of relay how it works now, consumers don't see big boosts in scores until they go from 100% to 90, and then under 75, then under 50, and then under 30, 25, and then 20, and then 10 is ideal. So now it's not just going to be this waiting period. So, and credit building tools. I think this is going to be the biggest thing. I would familiarize yourself with the credit building tools, because these are going to be a game changer for you. This is the new quick boost option versus using rapid rescore to pay down balances. So primarily self-reporting. Yeah, go ahead. Someone had a question.
Yeah, you said that paid collections will now have a positive instead of
Correct.
before could have a negative, but here it says collections under $100 are ignored. So, so tell them not to pay off a collection that's under $100. I mean, of course, that would be the easiest one to pay off probably. So
Probably, yeah. Yeah, collection under 100 are going to be ignored. Anything over 100, if they pay off, they'll see a score boost. It's
Okay.
not going to be something where you could you have a $500 collection, you pay off 401 and you leave $99 and it's ignored. It's not something like that. It's based on the original amount. So keep that in mind. People always try to game the system and hope things like that'll work.
Okay, and then third-party collections are, so when the I'll get this out, creditors sell to a law firm to collect, those are going to be ignored now?
Paid.
Oh, paid third-party collections are ignored. So, okay.
So the main difference is this could be with an original creditor,
Okay,
or a third party, and then this is with just a third party. And it's not necessarily a law firm. A third party can be any third party debt buyer. So
okay. Well, it doesn't look like we're going to be able to boost their scores as easily as we used to be able to do. So,
not necessarily, yes and no. You'd be surprised how big of an impact these credit building tools
okay.
will have. There's certain profiles you're going to have a much easier time creating boosts with, and then there's other profiles you're not. I'll give you an example. The person who has no negative credit history and only high credit card debt, they're going to be someone that is, you have very limited, almost no options. You may be able to use some credit building for them, but not near as much. The person who has negative accounts, charge-offs, collections, all that negative history, you can use a combination of credit building as well as paying things off now and get rewarded, where previously paying things off wouldn't necessarily reward you. So those people, you're going to see bigger boosts faster. But the caveat to that is we also know they're looking at negative history more severely. So we'll kind of have to see how that all shakes out in the end. We're getting access to the lender score in the next 3 weeks, this FICO 10T and 4.0. So we're going to start using that obviously with our client base and seeing what that means, and how these behaviors are changing and our advice. Because obviously we work with the people who have, negative history. So we'll be able to interpret the biggest differences. Because right now, obviously, when we advise, we're using the same models as you are. So.
Okay.
But we will see. So I think I pretty much already spoke about this, so I'm not really sure I need to bring that up again. As I mentioned, old timeline, it's changed several times, honestly, over the last several years. I've been preparing for this since 2022. And now it's getting pushed again. Everything's now TBD. Most of that is because investors, they put a big stop on everything. Their biggest concern is this buy merge reporting right now, because of the ability to cherry pick and not be able to properly assess risk when they're buying on the secondary market or selling on the secondary market and buying. So yeah, that's the same thing again. We have seen this is being used now. So even though I say, hey, it's not fully rolled out, really what that means is it's not required yet. But we have Cardinal Financial, Movement Mortgage, Cross Country. I don't know this company, Primus Mortgage Company. Maybe some of you do. They are all utilizing 10T right now. And we're seeing more and more and more companies start to use it because they want to get ahead and implement it before all of a sudden they have this internal requirement that's hard to meet. So, and then 4.0 is also being used by primarily by banks and credit unions. So it's interesting. We are starting to see some adoption take place. And then we did see Cardinal Financial, they did their first MBS with FICO 10T. That just happened in November. It's the very first one. So I think we're going to start seeing more and more roll out. So I know I say, it's to be determined, but I think it's just best that we are all aware of what's going on. because it's going to be here before we know it. And you might, if some of you are brokers and you have access to a whole bunch of different lenders, you may have some of these options available to you sooner rather than later. So.
Okay, a couple of questions, Ivory. And this has always been a pet peeve of mine, and maybe it's just the credit agency that we're using. But when somebody has a collection and it's been charged off, they still, for 2 years or 3 years, they'll still keep reporting it 30 days past due, even though it's been charged off for 2 to 3 years. Are they ever going to force the credit reporting agencies that once it's charged off to quit reporting it as a 30-day late? Because this is how my brain works, and this is what I told, but I'm old, and so I go way back. That once a creditor charges off, they get the tax benefit to that. So they shouldn't keep reporting it after that.
They can keep reporting charge-off status until it's settled or paid. Once it's settled or paid, they have to stop that monthly reporting of charge-off.
Yeah, see, to me, that just should not be, but that's just me. Okay. So that's not ever going to change. Okay.
No, and on the collection company side of things, they are supposed to be reporting it monthly. They don't all do it, but that's why sometimes when a client pays a collection, all of a sudden their score drops. It's because that collection company hadn't been monthly reporting, and now that payment caused them to monthly report and to drop their score. And that's not true for every time a consumer pays a collection. If it's a company that was already reporting monthly, they're not going to see a big score drop when they pay it. They're not going to see any change. So there's a lot of nuance to credit reporting laws and information and data, and yeah, that's kind of our playground. But I mean, you definitely, if you do have a consumer who has a charge off and the balance is still there, if they settle on it, I never tell them to pay. No, they don't need to pay the full balance, but if they settle on it, they will see a score boost from settling on it.
Okay.
Not as much as it's gone.
Yeah. 99% of the time when I see that, we're talking thousands of dollars. It's,
Sure.
I don't know, repossessed car or a medical debt or something that just, so it's not like a small amount that somebody could come out of pocket with. So.
Sure. Yeah, your options there are credit repair, where you're looking at the data issues to get the negative accounts removed. It doesn't absolve someone from owing the debt all of the time. Some of the time it does.
I guess what frustrates
settlement.
me is it keeps it in the current 24 months. So each month they report, so it just keeps it there. So it keeps affecting their score where, after it's 2 years old, it shouldn't be affecting their score, in my opinion, that much. So that's, I guess, where.
And you bring up an excellent point. So for the model you're using right now, Classic FICO, it doesn't have that time waiting of 2 years.
Okay.
That's only on the newer FICO models, where after 2 years it becomes less impactful.
Okay.
So the new model that you'll switch to will be like that.
Okay.
Yeah.
So that will help. Okay. Even though they keep it every month. Okay.
Yeah, that will end up happening with the new model. So you'll have that to look forward to. But otherwise, I will tell you, most of the older the debt, a lot of times they'll settle for 30%. So it can be a massive savings.
Oh, wow. And our payday loans still look the same way? That anything that's paid installment less than 12 months, are they still being looked at the same way?
To be determined. So there's actually there's a big argument going on right now internally between the bureaus and the CFPB, and how they want to look at payday loans and really any short-term loans like buy now, pay later, because they are messing up the algorithm. Because if you see the people who get those payday loans, their average age of open accounts, oh my God, it's further back than I realized. Their average age of open accounts is really adversely impacted.
Gotcha.
So right now, I would say just stay tuned. And honestly, I just can't remember right now off the top of my head, but one of the bureaus isn't even factoring payday loans, or excuse me, short-term loans buy now, pay later specifically into the credit score unless there's a missed payment. Just because it's affecting the score so much, and they don't
Okay.
think it's an accurate representation of risk. So basically, I mean, we're kind of talking about this. Credit conversations are going to have to evolve. Things are going to be different in how we have to advise consumers. So I mean, really, financial literacy is going to become more important, teaching people how to budget and pay things down. And we all know we have a financial literacy crisis going on in our country right now. The nice thing is people with thinner credit profiles are going to be scoreable now. You're not going to encounter very many scenarios where someone just doesn't have a credit score and you have to wait, or you only have one bureau to score them with or to qualify them with. And you'll be able to use, rent reporting, utility reporting, telecom reporting, all those tools will be able to be used. And most of those show up on the report either instantly the day they add them or within 2 weeks. So those are pretty quick solutions. So yeah, and then obviously we talked about the credit cards. Underwriting disclosures are probably going to be a little bit different too. So that's just something we have to be aware of because it's going to be incorporating that trended data logic. And then we're going to see more approvals. This is what's been anticipated as more approvals for borrowers that are not qualifying today or are unscorable. So I think, and then the younger borrowers are going to be more likely to qualify now as well. People with that limited credit history. Goodness, I couldn't get that out. So I think that's pretty much it. That's all I had for today. This is my contact info if you have credit questions, algorithm questions, anything. But also, of course, I'm open to questions now too about this or anything else. Nothing?
I have a question. What about insurance companies? Are they going to start using this to risk rate people that apply for homeowners or car insurance?
So insurance companies have their own credit score, and a portion of that score comes off of the FICO score, but that's just like a piece of their overall credit score. So that's a long way of saying I don't know if they're incorporating this new 10T. I would guess they're probably going to adopt it sooner rather than later as well because it's a better measurement of risk. Go ahead, AJ.
I can tell you because I've recently taken a job representing and working with an insurance company, and it was one of the questions I asked because I have a mortgage background. And I have to disclaim I do not write insurance or as I'm not a licensed advisor, but I'm an educator. So they are using it. They're
Cool.
using it in a way that collaborates with the systems that they have in place. And it's kind of like when underwriters go and do an asset search to make sure you're putting all your assets on your loan application because stuff sneaks in there about other properties that may not be listed. Insurance companies have a different system that they use that follows the property and the buyer, borrower, insured person, but they do incorporate the program of the credit score, and they use the worst case scenario. They're not the ones that use the middle. They actually use the worst case scenario when risking you as a person, from what I understand. So if that helps,
Cool.
they do use
Thank
it.
you, AJ. Any other questions from anyone on today's topic? Or I think the other hot topic, I'll just bring it up. We've got time, might as well. Anyone have questions on student loans right now and everything going on with the student lones? That's probably
Yes.
the biggest hot topic.
Yes.
So I figure we take the opportunity. We're all here.
I just want to say thank you. Ivory, I'm gonna have to listen to this as a recorded version because I gotta step away. But thank you. This is like I don't think we all know what's really going on. So thank you for making this more clarity to us and kind of timelines, because like you said, that this moving target of timelines and then anticipation of it. But it's interesting that you brought up that Cardinal did some of that. So it's, I think, gonna be massaged in slowly. It's not gonna be a rip off of a Band-Aid. So more to come.
Yeah, I know there's at the end of last year there were 20 lenders using it.
Okay.
So
Out of
I
how
just don't.
many?
Yeah, what a way to confuse everybody, right? Only some of
Yeah.
them using it. I mean, I
Right.
think this is going to be something as a
Mhm.
lender, it needs to be, brought to attention. I don't hear anybody talking about it, you guys.
No, it'll happen. It's a, like you said, a slow rollout, but I just
Yeah.
want to thank you. I didn't want to just disappear and they're like, where did
Oh,
Annette
you're
go?
good.
So,
Right it.
but I definitely want to hear about the student loan stuff. So I'm going to listen to the recording. So thank you, everyone.
Bye.
Yeah.
The
Okay,
student
anyone
loan
else?
stuff is a true pain point, you guys, real pain point right now.
What are you guys primarily seeing on your end right now with the student loans? Because I have all sorts of information and answers and
So I have customers that were on deferred or
here,
afforded.
I'm gonna stop sharing.
Yeah, pay as you can afford. And they were on that plan or that were in deferment. And now all of a sudden they've got balances or their payments have tripled. I've seen that on a couple of my clients where all of a sudden they have a $600 a month student loan payment and they're like, what? And now, of course, they can't make it. And so now they're being reported late. And it's a nightmare.
Okay, what else? What else does everyone else have? And then I'm gonna just try
Well,
to address all of it.
keep hearing people say, well, they're going to be forgiven, so why should I pay it? And I'm like,
Yeah.
no. So
Yeah, and wouldn't that be nice? But I mean, I think a lot of people buried their heads in the sand. So part of what happened, actually, I have a fun slide I can show. Part of what happened with student loans is we had, as you know, as all of us know, things were paused for quite a while because of COVID, and then things kept getting extended. And then we had litigation going on with some of the student loan stuff. And this is what happened with student loan default. I'm slowly making my way to the slide. Here it is. Okay. Share screen. So student loan delinquencies, I know this isn't very big. Student loan delinquencies are this red line. Boop, it just dropped, right? And then there were still some delinquencies, but these were all private. So this is what happened when we were told that, well, I should say the bureaus were told that they were not allowed to report delinquencies on student loans. That being said, student loans resumed a long while ago, quite a while ago. The payments did. But the delinquency reporting was not allowed to show up on credit reports until December 2024. So a lot of people were past due this entire time. And they went into default, meaning default would be 7 consecutive missed payments. I want to say it's 7 or 9. And so those individuals just started getting reported delinquent on their credit. And a lot of them are now saying, oh, I never knew I was past due. I never got any notice. And while some people truly, their servicers changed and maybe the servicer messed up and passed the information to the wrong address, even though, that's a rarity. Sure, some of that happens. The problem is that doesn't even matter because they all have a clause built into it that says the loan is due regardless of notice or not. There's no out for that consumer. So there's been a lot of people that have been past due this entire time. We've got 8 million borrowers that are defaulted on student loans currently, with another 9 million expected to be in default when the SAVE legislation, like the infighting on the SAVE program is done. So we've got a massive delinquency crisis going on. And I think a lot of it is because people are confused and jaded from the forgiveness discussions and the not reporting. And there is just a lot of confusion out there. But the difficult thing is they're government-backed loans. So there's not a lot of out for the consumer. You can't get out of these loans unless you die. That's it. So that's the unfortunate thing. So the best thing that someone can do in the instance of being delinquent, and we'll talk about the other couple of things as well, is obviously call the servicer and set up a payment plan. They will do retroactive deferment. So they will retroactively remove the past due balances, not the late marks. Some servicers will remove the late marks, not all, but most won't. But that will at least allow that person to be caught up by only making the payment that is due in that given month. If they're fully in default, meaning that 7 payments or more missed, they will have to pull that loan out of default, which would involve making consecutive on-time payments for a period of time. Off the top of my head, I can't remember at the moment. I have it written down. And then that will pull them out of default. It will put them into a new servicer. And then you'll see that new loan appear on their credit report after they finish those trial payments. With online payment history starting right away, it'll consolidate all defaulted loans. So that's what will happen in those scenarios. It won't remove the old negative account from their credit report, but it will start a new account fresh on their credit report. And it's the same reporting rules that follow 7 years from delinquency. That old account will stay on their credit unless you can find it, unless you can find compliance issues, through credit repair to get it removed, right? So that's that part. Anyone have any questions on any of that? No? Okay. So balances changing or balances tripling, they have changed. I was thinking of doing a whole webinar just on this because last week was at a conference with a student loan expert. He's a student loan lawyer. Would you believe there's a student loan lawyer? Like, that's a field. He just sues the government for people. So he was talking about the differences with the new repayment plans. They are all changing. And it's going to be a lot harder on people. The only people that I think are going to have a little bit more of an out are self-employed individuals, because they can write a letter that says what their income was on a very specific month. Maybe it's the month where they've made the least amount of money. And it's a self-certified letter where they can say, this is my income, and they're basing the payment off of that gross income versus their tax returns. So otherwise, right now, the calculation itself for repayment has changed. Now, people that are in the SAVE program, they are going to be grandfathered into the old repayment plans. But anybody else, it's basically going with the new calculation, which means higher payments for everyone, a lot higher payments. Repay is gone, it's dead. That's not coming back. So that's the bad news. But the House right now, they are proposing to get rid of all income-driven repayment plans except for the IDR. So there's a big shakeup in the whole student loan system right now. And it's all going to be based on, let me tell you the new payment program. It's called WRAP. So I'm going to read it to you. So it's nothing like the income-driven repayment plans. The current IDR uses the poverty index and adjusted gross income. In WRAP, for every child under 17, you can reduce your base payment by $50 per child. The base payment is based on the adjusted gross income and a percentage of it. There's no more $0 payments. The minimum payment is now $10. So if you make between $10,000 to $20,000 a year, your payment's 2% of that. If you make $30,000 to $40,000, it's 3%. And so it adjusts up 1% for every $10,000 you make. So that means if you're making $60,000, it's a $250 payment. So it's a massive increase in payments now. So yeah, the self-employed people are, like I said, the only ones that have an out because they can use a single month of income and make it be their lowest month. So, yeah, I mean, there are some changes to where if your payment doesn't cover like interest, So let's say your payment's $250, but you have $300 in interest. They waive that excess $50 of interest. That's the only real silver lining. So, yeah.
Have you heard anything on situations where somebody goes to work after school? They go to work for, in my case, I have a customer that's working for a tribe and they're
Mhm.
giving them a stipend, but it's given at the end of the year after they've already worked the year, then they pay towards the student loans. So they don't want to pay the student loans because it's going to be paid through their job.
Mm. I don't think they're gonna have a choice. It's kind of gonna act like a reimbursement, it sounds like. Are the job paying the student loan company directly, or are they paying the client?
Directly.
Oh,
Yeah,
Yeah.
wow.
they do a reimbursement.
I
As
don't
long as
know.
This is through the Indian tribe.
I've done one and we did get to count it, but he'd already been there a year, so they were already paying it. It wasn't, he didn't have to wait a year. So where you're gonna have an issue is having to wait a year. He'll have to make payments for a year.
And then have
Yeah,
the actual creditor reimburse them.
yeah. And then after that, they should be paid directly to the student loan company after that, so.
Everyone's with federal loans is eligible for 2 years forbearance during the life of the loan, like outside of obviously deferment and then the 1 year after leaving school. So I mean, you could see if they could do a year of forbearance as long as they qualify under their particular servicers and loan type. I mean, but historically getting a forbearance has been as easy as calling and saying I want a forbearance. So I don't know if that's going to change now too. But that may be an option, once you use the 2 years, you use the 2 years, there's no more. So that's something to keep in mind. But that would be an option. So yeah, the student loan situation is going to be interesting too, because they are going back to the ability to seize assets for defaulted student loans now as well. I think that's supposed to roll out June or July, I want to say. Let me check. Maybe it was, let's just say this summer. June 15th.
So you're saying they could actually put a lien against somebody's property if they're in default?
Oh, no, it's worse than that. What they can seize bank account assets.
Whoa.
Yeah, so historically they've been able to do that. It was put on pause for a while, but so many people just went into default and just were like, yeah, whatever.
Well, it's because everybody thought their student loan debt was gonna be paid off.
Right. And they'll garnish tax returns. That's nothing new. But they're releasing the ability this summer for being able to basically garnish assets. And there's specific rules around it. I have it all written down. So I mean, I can send that if anyone's interested in that, but that's all of course available publicly too. But it's interesting.
Would you send that to me? I may need to get that to my granddaughter.
Yeah. Will you send me your email?
Yes, I will.
Just put it in the chat.
Yeah.
Yeah, I'll send that to you. I'll send you all my notes on the student loans if you want. Yeah, it's interesting because it's not often you get access to the person who sees all the behind the scenes stuff with the student loans, but yeah, it's going to be interesting. There's a lot of changes coming, and we'll see what that means. I think my biggest concerns going forward for consumers in general is obviously student loans, but also credit cards. It's just the high level of debt we have right now is just scary. So yeah, I'll send that to both of you. All of you. Okay.
I mean, that's
But-
kind of scary that they can just start taking people's assets out of, I'm sure they're going to send them letters, right? They'll give them plenty of notice, or do they just go in and start pulling money?
I don't think that they necessarily have to provide them with letters. They've been warned. I mean, they went into default. So
Right.
it's, I mean, all they're, if it's just like, so as far as garnishment goes too, let's say somebody already has a garnishment, for, let's say like a Chase account or something like that, like a Chase debt. The Chase debt is bumped in line, even if they've already been garnishing, and the student loan
Whoa.
garnishment goes first.
So,
Like just like your taxes, right? Just like taxes.
so
And then
my,
they can't get a FHA loan. They can't get a FHA loan if they're behind in their student loans. Is that correct?
I'm not a guidelines person.
Yeah, I'm pretty
I
sure
would
that
assume
might
any
be.
federal debt's going to prevent them from being able to get a federal loan.
Yeah.
I'm assuming that's why Cavers is pulled, right?
Yep.
But
okay, so my granddaughter is engaged, so she doesn't want her name on his bank account.
Uh-uh.
I'm assuming.
no, she does not. No.
Gotcha.
No, because they'll have access to it then.
right.
Yeah.
Okay.
Yeah, that would be a no-no. Yeah, I'll send you. I have all the rules on the garnishment and all of that. I'll just send you my whole list of notes.
Thank you.
On all the student loans. It's a lot, so happy reading. But yeah, I mean, we really strive when it's anything debt or credit related, we try to stay on the forefront of knowing everything that's going on. That way we can advise our client base, or at least have the resources to give them. But at the same time, the way to prevent that garnishment is just contact the servicer and start the trial period for a payment plan. So it's very fixable, right? As long as they contact their servicer, they start their trial payment plan, they don't have to get garnished. So, you know,
You also
sooner-
said they could, okay, you also said they could put it on deferment, but if they're past due, will they still put it on deferment?
no, nope.
Okay. Okay, it has to
No,
be done.
not if
before
you're
you get
past
that.
due.
If they've been,
Yeah,
I
they'll
might
have
have missed this question, but if they are in garnishment, is there a way for them to come out of garnishment and go into a payment plan? Or is it too late at that point? Did they
I feel
say?
like I should have the answer to that, but I don't want to answer incorrectly.
Okay.
I'm not sure.
Because that's when we're gonna see it, right? By time it's already, when it becomes a negative issue on their credit, that's when we need to have a solution more so than if we haven't, talked to them or seen their credit yet, and then once it's pulled, then it becomes the eye opener to all of the lenders.
So here's the thing though, too. It depends on how old the debt is, right? Because you could have a default. Other debt has a statute of limitations for legal action, right? It
Right.
dies at a certain time frame. It depends on the debt type in the state, right? Student loans, there is no expiration. But there is an expiration for credit reporting, meaning if that loan's been defaulted for more than 7 years, you're not going to see it on the credit report, but they still owe that debt and they
Right.
still could be garnished for it, right?
Right.
And they still need to pull it out of default. And then once they pull it out of default, finish that trial period, it'll come back on their credit as a new account. So that's the hard thing is, it's like, because if we think like, okay, COVID, how many years ago was that now? If people started going past due before COVID, a lot of their stuff is close to being off the credit report. Especially if they were, delinquent, a year before COVID, right? Like, so time's going by so quickly. It's like, of course, 5 years, from COVID, when you finally start reporting delinquency, we're going to have issues. If for the last 5 years, people haven't had to pay and worry about their credit. It's like, duh. I don't know. So we'll have to weather this storm and we'll figure out what we all need to do together. I will say we are working on a lot of student loan delinquencies right now. And there are situations that there are invalid reportings of delinquencies, but the vast majority of the time, the client's wrong. But if there are, it doesn't mean that the late marks can't be removed from credit. Sometimes you can get the right the right person at the servicer to remove it, or you can find compliance issues with how it reports. Maybe it's misreporting across the 3 bureaus. One bureau shows 1 month, the other bureau shows the other 2 months, right? Whatever other issues, or you don't see a billed out amount. You just see a past due amount. You know, there are compliance issues that exist to where you can at least get the score up. It doesn't mean they weren't past due. But some things are still fixable on the credit report itself, and as was true with any kind of debt, right? But you know, we just got to figure out a way to stop getting people to bury their heads in the sand and hope it goes away. So
Yeah, let's hope.
yeah, but I don't know. Well, that's all I got for today, but I'll send the 3 of you emails on that. And just reach out to me if you guys have any credit questions or anything else.
Thank you so much. You were very informative.
Yeah, absolutely.
Thank
Very-
you.
Thanks, Ivory. You're such a great addition to our group.
Oh, thank you.
Yes, you are.
I can tell you all, I did refer a client into them, and they were on it right away. They reached out to my client, offered them several options, kept me in touch of their process and what's going on, and the result of the referral. So, you know, if you guys get a chance or you need her help, I highly recommend that, you know, you reach out to her, you guys. They
I
do a good
appreciate
job.
that endorsement.
What's the average cost for like the services for the credit repair and such?
We have a no cost program for people who can't afford anything. The caveat to that is it's a year-long program. Because we basically find the compliance issues on the report and we sue the credit bureaus. So it takes about a year to go through litigation. We get paid by splitting the settlement with the consumer, and then the consumer walks away with cash in their pocket, a cleaned up credit report, and then they can get the mortgage. So that's our no out-of-pocket cost option. Otherwise, we have 2 other plans. One's 90 a month, the other's 170 a month. And then we have our do-it-yourself software, which is free, but they pay for accessing the report. With the AI added to the report stuff, it's $39 a month. So
Cool.
Mm.
Interesting. Okay.
I was gonna say, and that's just until it's resolved, right? It's not an ongoing,
Yeah,
it's just
everything's
until
month
the
to month.
resolution.
yeah, everything's month to month. So by 6 months, we want everyone buying, and then whatever's left after that 6 months, we're transitioning that person to litigation after. So it's basically goal is to buy, you get to buying, and then we flip gears and go into litigation for whatever's left on the report that has compliance issues. Like every report has compliance issues. That's what's really crazy about credit reporting. And the bureaus just don't care because it costs them too much to try to maintain or fix that. It's just realistically not really possible. Maybe it is, and I don't know, but they don't do it regardless. And when we're looking at reports, like the reports you see are very consolidated. So we're pulling the annual credit report, and if you've pulled one of those, you'll see, you know, there are 100+ pages. We're looking through every piece of data there. If we see any missing data, inconsistent data across the 3 bureaus, or data that's too old, then that's all a compliance issue. The bureaus have an opportunity to fix it. We give them 6 opportunities, i.e. 6 months. They technically only need 2 to sue. And then we sue for anything left. Some's going to get cleaned up along the way. And then the rest we sue on later.
And
So-
that has no adverse effect to their credit afterwards because of the fact that you cleaned it up.
Right. We don't like there's companies who do like credit sweeps or they claim fraud on things that's not fraud. Like that's not legal. And that's why things will come back. Now, could a bureau reinsert something after removing it? Yes, but that's not legal. Then you would sue the bureau if they did do that.
Ooh.
So
Interesting.
yeah. Yeah, it's interesting. And if you have clients that have like ID theft or they're a junior and their father's a senior and they have a mixed credit file, refer them because that's a 6-figure payout for them.
Oh,
Like
wow.
after the attorney split. And the mixed files are high 6-figure. So,
Ooh.
it's an interesting industry.
Yeah.
So yeah, and some of these things, like you get something off the report, it doesn't mean that that consumer doesn't owe it. Now, some situations we find out they don't, right? But what we can do with litigation then is now they have the funds to take care of it. Now they'll have the funds to pay it. Or if we're suing for something, they are now having to forgive that debt or waive that debt because what we're suing for is a bigger issue and worth more statutory damages than the actual debt itself.
Okay, you just brought something up. I'm sorry, guys, I gotta ask this. I'm in Oklahoma, so we have Cox Communication.
Oh God.
And okay, and I don't know how many of you know this, but if you ever return anything to somebody like Cox Communication, you get a receipt that you returned it, because what these young kids do that work there is they take that box that you returned and they give it to a friend. And then you get a collection for not returning the box, even though you returned it, but you have no proof because you didn't get proof of it. But who thinks about this? Well, I desperately tried to find out how to get a hold of Cox Communication and somebody higher up, because this happened to a friend of mine who bought $1 million home. So she just paid it thinking, oh, it's $250, who cares? But it ruined her credit.
Right.
And is there a way to sue people like Cox who do that who allow that kind of stuff to go on, or don't even, they probably don't even know, but there's no one to call to complain to?
Can't get it. It's like calling the
Yeah.
IRS. You can't
Yes.
get
You
it.
you
Who
can
do you
sue
call?
for it.
Yeah.
We do all the time for Comcast too. I mean, most of them. So and it's also going to be the third party debt collector you're suing, not necessarily Cox. You might sue Cox Communications, but it's probably the third party debt collector because they're buying the debt, like they're buying ledgers of debt, right? Like they're buying a giant spreadsheet of debt.
Yeah.
That's it. Well, there's certain requirements to collect on that debt. And then there's, I'm gonna be careful with what I say. We're recorded. There's certain requests that you can make as a consumer for communication or what have you. And if there's violations of those requests, you may have a claim against that debt collector for another reason as well. So it's a strategic process you can utilize to not only help clear it from the credit report, but increase that potential for the monetary compensation for the consumer. And then they have to stop reporting it. They have to waive the debt. Obviously, if it's paid, then that's another issue. And if you can prove that they were billed something they shouldn't have been billed, or attempted to collect on something already paid, then
Well, see, that's the issue. They return their box because they're moving to a new location, out to another state or city. Sorry, not state, but city. And they return that box in Owasso, Oklahoma, because they're moving to Norman, Oklahoma.
Mhm.
And then they get down here and they re-sign up with Cox. And then they find out that they got hit for a box they returned.
But what information do they have internally, right? Like when the attorney requests data and requests information, it's possible internally they may have tracked that something was returned or dropped off or a receipt was produced or whatever.
I think these kids that work there have learned that it isn't tracked, and so they can then turn around and give that box to a friend who gets quote unquote Cox Communication free, because I see this so many times in Oklahoma City, to the point when I returned mine, I took pictures of me returning it.
Yeah.
I took pictures of and I made her give me a receipt. She goes, we don't give receipts. And I said, I'm not leaving here without one, because this is what happens. And I got one.
You'd still have a sworn affidavit, right? Like as a consumer, I would provide like a sworn affidavit. I did something, right?
Yeah, but it's he said, she said.
It doesn't mean it doesn't have weighting.
Okay.
It doesn't, you combine that with the other factors, right? It's always a stacking of issues or a stacking of claims. Is it the most amazing case? No.
Yeah.
But if you find other issues, there's a high likelihood you can get it off the report. Now, you can probably get it off the report just through traditional credit repair rather than going litigation too. But if you want to go litigation to see if you make money off it, it's like, why not? That's kind of up to the consumer at the end of the day,
Okay.
So, yeah, but I mean, we're used to dealing with utilities all the time.
Okay.
Very normal. So,
Okay.
yeah, we see it all.
All right. Well,
All right.
you may be stuck with me, Ivory. I may be emailing you a lot.
I'll send everyone the email on the student loans. And then, yeah, I mean, feel free to reach out to me. I'm always happy to look at credit reports and my team too. And we're happy to just advise clients, you know, even if they're like, they don't want credit repair, we can give you guidance on the actions they can take to help improve scores outside of what you'll see in Wayfinder or whatever you're using internally. So
Okay,
yeah, that's what
Well,
we're here
you
for.
you're wonderful.
Thank you.
Thanks. All right, I'll send that out your way now. And then it was a pleasure to meet everyone. And
Thank you.
I think I'll see some of you next week.
Yes, absolutely.
Bye.
Bye.
Everybody,
Bye.
Bye, kids.
have fun next week.